For more on Netflix's results, let's bring in Rich Greenfield of Lightshed Partners, a man who scrutinizes the media business for a living. So, Rich, I don't know what to tell you other than that stock move is pretty dramatic. What exactly stood out to you, and what exactly, in your mind, drove the steep reversal that we've seen?
Well, two things stood out, Dominic. One, the Canada commentary. So if you read the release, there was a tremendous amount of investors who were very worried. They were looking at early data, both subscription data as well as sort of Twitter commentary of people really pissed off in Canada. They were seeing consumers upset about the password sharing changes, and there was a fear that cancellations were piling up, and that effectively, I was hearing from investors just a couple of months ago, Netflix is likely canceling its rollout of password sharing. They can't move forward. Canada's such a disaster, they can't do this. The release today comes out and says Canada's actually going great. It took some time, but they actually have more members in Canada today than when they first rolled out password sharing. And so it is a net positive, not just to subscribers, but clearly to revenue growth. And that's what investors want to hear. That's why I think the stock is ripping back, is because the fear factor, which was password sharing is too hard to accomplish this crackdown. It is obviously not true. They're rolling out the US in Q2, and it sets the stage for a big growth in both subscribers and revenue in the second half of the year. The other thing that I think is really important in driving the stock is advertising. There's been a lot of noise. I'm sure you've heard it and talked about it on CNBC over the last couple of months, that advertising was off to a slow start. They revealed today that the total ARPU, meaning the amount of money they make per sub per month from the advertising subscribers, they only charge $6.99 a month, but they are saying that that advertising subscriber is actually more valuable in terms of revenue per month than their standard plan. That standard plan is $15.49. So that means the advertising ARPU on top of the sub ARPU for those subs is over $8.50 a month. That's like Hulu territory 5 months after launch. That's literally mind-blowing.
So Rich, I want to bring you something that Julie Beal talked about just a few moments ago. She mentioned the writer's strike. All right, and it wasn't so long ago that whenever we talked about media, streaming or otherwise, we talked about content being king. There is a looming writer's strike. How much could it impact Netflix, perhaps others, and just how much should they be worried about a potential hiccup because of this looming writer's strike?
Well, if you remember back to the pandemic, Netflix actually works a year ahead of time. So they have a tremendous amount of content stockpiled. They'll actually be able to probably last through this far longer than others. Most importantly, because where does a lot of Netflix content come from? It actually isn't U.S. content. More and more of the shows that you're watching in the U.S. come from overseas. And so that importation of overseas content is something that none of the other streamers have, and is a meaningful advantage for Netflix versus its peer group. And remember, a slowdown in production actually boosts free cash flow. That's what happened to Netflix during the pandemic. We actually wrote a piece yesterday of why we think the writer strike could actually be a short-term positive for both Warner Brothers Discovery, that's WBD stock, as well as for Paramount, PARA stock. Both of those companies, if you saw a slowdown in production, that would help their free cash flow in 2023, which is really a core focus for investors in both of those stocks. So I don't think a writer's strike is a problem for the sector, at least in the short term. If a writer's strike lasted a year plus, all bets are off. But our assumption is you'll probably see a 3+ month writer's strike, and it's going to be problematic for the writing community, and certainly is going to hurt anyone who's attached to the film and television industries in Hollywood. But I don't think it's a reason not to own Netflix stock. If anything, it could be a benefit to Netflix.